Is Scribd, an app that gives me access to ebooks, audiobooks, podcasts, and more. With Scribd, I can get in my steps and countless pages. Scribd makes every moment a reading or listening moment. Go to Scribd.com and try it free for 30 days.
Last year, more homes canceled cable TV than ever before. Why? It's just too expensive. For half the price of cable, you can get Fubo TV and watch the live sports and TV you love. Try free at FuboTV.com.
We're passionate about growing your business online, but the tech stack it takes to do it sucks. That's why we built Kajabi, the all-in-one platform that makes it easy to build digital products, create websites, send emails, and much more. Get started for free today at Kajabi.com.
This is Bloomberg Markets, the open on a down day, the second in a row as we take a look at the NASDAQ leading futures lower here. You see across the board, though, with the NASDAQ down more than 1%, losing some of its steam as we head in. Russell down actually outperforming, down just 0.4%. And what you are seeing is a flight to bonds. The irony of a tightening trend, what you're seeing in central banks around the world, leading to more demand for bonds, down basically very little, 1/10%, less than 1/10%, 1.39%. Meanwhile, you're seeing crude off just a touch. There are some geopolitical issues here, but also the prospect of Omicron crimping demand, and the dollar strength pervades. And this has been an ongoing theme for risk-off days when the dollar strengthens, the euro weaker, 113.07. Right now, let's head to the markets desk. Bloomberg's Abigail Doolittle joining us now with some of the things she finds noteworthy. Abigail.
Well, Lisa, it's all about this risk-off tone. The NASDAQ 100 futures right now on pace for the worst week since February of this year, down about 4%. And of course, we have a big earnings debut for the recently made public Rivian Motor. Shares are plunging after a disappointing quarter, much wider loss than expected. They missed revenues, and most importantly, perhaps, the EV output target missed for the year. Of course, they were expected to produce 1,200 cars this year. It will be less. So the valuation of that stock continuing to come in. The stock now below where it opened on its IPO day just a few weeks ago, Lisa. As for that big tech sell-off, let's take a look at it because we do have the shares of Tesla, probably not down because of Rivian, but because of this sell-off that we've seen this week. Again, the NASDAQ 100 futures down about 4% on the week, the worst week since February. A little bit of a puzzle given the fact that yields are in on the week as well, perhaps suggesting that investors think that the trend could be higher or perhaps, of course, year-end repositioning, Lisa.
Thank you so much, Abigail. High-growth tech names erasing some of the post-Fed gains. BNY Mellon's Alicia Levine weighing in.
The cycle that you're seeing here is really about a change in tone, a change in regime, the possibility of tighter policy next year, not just at the Fed, but globally. And so the sectors that you would expect that would be, responding to that a little bit more defense are doing well. We think tech is overdone here. The long duration assets, those more speculative companies will have challenges. But really, we think that tech ultimately is where you would like to be.
Kriti Gupta joining us now for more. Kriti.
Yeah, Lisa, tech led the way higher, and tech can also lead the way lower. That is really the message that those heavyweights are really sending when it comes to the market. And of course, after that Fed pricing, tech not really holding steady when it comes to that very, very large hike or monetary policy that you're starting to see priced into 2022. And of course, that's going to hit long duration assets like the NASDAQ 100 or like big tech. The big question here, though, is how much of this is a function of extremely light volume. You are seeing the 10-day average, or the NASDAQ, I should say, trading far, far below its 10-day average in terms of volume, and technicals are playing a factor as well. For the majority of this year, you have seen the NASDAQ 100 bounce off of its 50-day moving average. But if this selling really accelerates going into the holidays, the 200-day is something you're going to want to watch, especially since we haven't tested that level since all the way going back into 2020. So what is the effect here? Well, Lisa, earlier this year, the correlation with yields used to be actually inverse. Now it's positive as you see the bond market really priced in that hawkish tilt, and those yields continue to drop. Tech tends to take that lead, and it's affecting the ARK Innovation ETF as well, which of course has already had a tough time. Those losses accelerating, Lisa.
Kriti Gupta, thank you so much. Trying to make sense of this market is tough, and the day-to-day moves we can get lost in trying to give a narrative to them. But there is a broader story that we're going to address now, and it has to do with whether markets have just become fundamentally divorced from what happens on the ground, and whether public markets have lost their efficiency. Back with us, Robert Tipp, Michael Weiss, and Ella Hoja. And not just have public markets lost their efficiency, but are private markets that much more efficient and the place to go? And I do think this is a very relevant conversation to be having at a point of potential turmoil. And Michael, since you had the firing shots where you were talking about how this really is the debate that you continue to have with clients, and I know you are focused on hedge funds and other private asset classes, what's your verdict? Why would you say that private assets are so much more efficient than public ones at this moment?
Well, I think there's more than just efficiency that's at play. I think we have to remember, what are people trying to solve when they invest dollars, right? And for some folks, it's about generating a consistent stream of passive income, a liability management. For other folks, it's going to be about setting up retirement or asset growth in the future. What's become clear is that in the public markets, two things have happened. With the success and the growth of private equity and private credit managers, which is broadly private investments and asset management, more of high-quality institutional investments are being held away from the public markets for too long. And so what that has translated into is that you're seeing companies that are debuting in the public markets at valuations that are much greater than they used to. And so the convexity and the asset growth that maybe our parents' generation used to be able to benefit from, we're not being able to see as early or as much of today. And so if you want to be able to build a portfolio that's going to show you consistent growth, you really want to be able to do it with marquee private equity and private credit managers. And the same goes for the consistency of passive income. When I look at my public equities portfolio, I'm not saying that it's completely inefficient. What I am saying, though, is there's too much volatility, and it's not what I want to experience as a consumer.
Okay.
And I believe that it's not just the consumer, it's also the institutional investor. When you look at endowments and foundations, and they need to sort of sit together and understand as a board, how are we going to manage our liabilities for the year? There's more and more of that allocation. I think we're up to 60% now that are going into the private markets.
So, Robert, I'd love your sense of this, because it's one thing to say it's an important part of a portfolio to go into private markets. It's another thing to say that right now, some of what the behavior is that you're seeing in public markets is not necessarily representative or predictive or as much of a signal as it has been in the past, that the former 60-40 that you used to rely on no longer is reliable. What's your view in terms of that outlook and the reason why people are moving so much more to the private asset classes?
Right. Well, I think that, the markets are reasonably priced here. And that's surprising for people because they're not used to seeing rates so low and multiples so high and so on. So usually what I hear when people are taking issue with 60-40 is they want to tactically go out of their long-term allocations and go into cash and wait for things to become normal. Wait for valuations to be more reasonable, wait for yields to be much higher, spreads to be much wider. And I think the fact of the matter is that, that time is generally not coming. I mean, the markets are volatile and they fluctuate, but that you're continuing to see the 60-40 allocation outperform people that are allocating to cash. So, within that context, though, to the extent that you have bottom-up research and you're getting paid for giving up some liquidity, going, on the margin into privates, whether it's within a public fixed income portfolio or elsewhere, and I'm not speaking for Prudential or I'm not speaking about particular investments we make on behalf of clients, but in the abstract, that if you're getting paid for that, it's a low return environment. If you have a positive market outlook, then that can be a good way to enhance returns.
What about you, Ella? Where does this fit in terms of either an alternative instead of some of the traditional allocations versus something to just sort of add some yield at a time when it's hard to find for the pensions and the retirees?
Well, we would say that the bigger driver behind the growth in private assets is exactly that. It's the very low yielding, low return environment. So we understand very well the need of our clients to not just diversify a bit more from traditional markets, but also to enhance their yields. Now, in terms of the role of 60-40, I'm not the point of authority on that discussion. Of course, I'm a bonds PM, but we would say that, of course, there's a function for fixed income in that space. But, you can argue that there is less efficiency in the more traditional sense of how financial markets have behaved. But we would also say that that's not a feature of particularly of late or recently. It's something that we've been seeing certainly since the global financial crisis of 2008. And with that has come the function of a lower liquidity factor in markets and the lesser ability of banks to actually warehouse some of that risk. And because of that, what you see is repeated drawdowns in markets due to either unforeseen events or one-off shocks, such as, for example, the one in March 2020. So we think any investor should position their portfolio with this downside risk in mind, with this more frequent spikes in volatility and the drawdown management aspect that comes with it. And on top of that, we also think that you need to run risk in your broader portfolio with your ability to actually buy this large shocks that we experience in markets. And you can only do that from a position of strength. So a managed drawdown situation.
There's a larger question here, Michael. As an increasing amount of money has moved to the private markets over the past decade on the low yield environment that we've been in, which is how much risk has gone outside of the purview of regulators or outside of the purview of people who are analyzing the dynamic in the market. And this has been one concern for the Federal Reserve. If they raise rates too much, does that unleash a wave of selling that people are not expecting? And is that perhaps why there is more volatility in big cap stocks? Because that's the liquidity hedge that everyone has. What's your view?
I think that you touched on two things. I think you mentioned something about assets moving outside of the regulatory purview. I'm not really speaking too much about that. I think there's still very much heavy regulation in the private markets as well, whether it be the SEC or FINRA, et cetera. I think there's clearly things happening more in crypto, and I'm not sure if that's what you're referring to, but I absolutely do believe that as people are seeing more volatility and getting more frustrated by it, and especially coming off a year like this where there's some attractive gains to take off the table, the notion of being able to diversify their portfolio further and moving into privates is absolutely happening. We've seen it substantially coming out of COVID, and I think we're going to continue to see it as the markets continue to present more volatility to different folks. I think there's a separate thing happening, which is really important to take a step back and look at the macro perspective. You have $70 trillion wealth transfer moving over the next 10 to 12 years from the baby boomers to the next generation. And how those folks are going to be thinking about deploying that capital is going to change over the next couple of years. And the volatility that you're seeing in the market is going to make a lot of these people less comfortable with continuing to deploy a substantial amount of their net worth as well as institutions into the market. And so I think we really have to pay attention to where that money is going to be moving over the next decade.
All right, well, everyone is sticking with us. Coming up, more delays for the Build Back Better plan. We're going to shift gears to Washington, D.C. Take a listen.
How important getting Build Back Better done. This is a priority for the president to lower costs again for Americans. That's what they want us to see us do, is to deliver, and that's going to be our focus.
That conversation coming up next. And right now in markets, a soggy day as the sell-off continues into the initial 10 minutes of trade, with the S&P down now more than 1%. Session lows here. This is Bloomberg.
This is Bloomberg's The Open. I'm Abigail Doolittle, and you are looking at a live shot of the principal room. Coming up, Mark Royce, General Motors president. That conversation at 10:30 a.m. Eastern, 3:30 p.m. in London. This is Bloomberg.
Any president wants anything to happen sooner, right? He wants us to get this done as soon as possible. He wants to deliver the Build Back Better plan for the American families as soon as possible. But we understand that it's going to take time, and we're going to continue doing the work.
President Biden admitting what we all knew or basically assumed, that his economic plan will likely be put off until next year, but saying he's confident it will eventually pass, releasing a statement saying, quote, "My team and I are having ongoing discussions with Senator Manchin. That work will continue into next week. It takes time to finalize these agreements, prepare the legislative changes, and finish all the parliamentary and procedural steps needed to enable a Senate vote." Bloomberg's Joe Matthew joins us for more from D.C. Joe, the question is not, is it going to get done this year? Will it get done at all if we push it into the new year?
Well, that is the big question right now, Lisa. Think of how many months you and I have been talking about this, all the gyrations, and when you look over the course of the last week, it's been just remarkable. As we watch this whole thing kind of fall apart for 2021, you go back to the inflation data from last week, then it was the CBO score, then Joe Manchin's meeting with President Biden that did not result in a breakthrough, all culminating in the Federal Reserve meeting this week that made Joe Manchin feel justified in his views about overspending and inflation. At another wrinkle last night, the Senate parliamentarian, as many predicted, struck down an immigration reform component in this bill. It's not going to work with reconciliation. And then culminating in that President Biden's statement that you just referred to. But this is not dead. I spoke yesterday with Cecilia Rouse, the chair of the National Council of Economic Advisors, who says, no, they're going to be working through the next couple of weeks. They're going to circle the wagons at the beginning of January, reiterating that this White House was never obsessed with deadlines the way the Democratic leadership on Capitol Hill was. There is a big motivator here, Lisa. It's the child tax credit. As you know, the checks went out this week on the 15th. It was Wednesday. There are no other checks coming until they get this done. And the White House and Democratic leaders on the Hill are not talking about a Plan B, a standalone replacement measure. They want to get it done here. I'll throw another date at you, February 18th. That's when the government would run out of money, and we're going to have to go through this whole funding mechanism again at the beginning of next year. They hope that they get Build Back Better done before then so they can deal with the matter of paying for government operations. I'll tell you what, though, just in any other world, Democrats would be taking a massive victory lap right now. They cleared the American Rescue Plan. They got infrastructure done, biggest investment in history in our roads, bridges, and tunnels. They even managed the debt ceiling for the balance of the next year here. But because they pushed this to the end with Build Back Better, this is what you and I are talking about. The fact of the matter is Democrats, considering razor-thin margins, Lisa, produced quite a bit this year.
Joe Matthew, thank you so much. I'm so excited that we get to look forward to another debt debate, ceiling debate that we're going to probably have again next year. Hoping not to have that debate, Robert Tipp, Michael Weiss, and Ella Hoja still with us. There is an issue of whether it's actually a bullish thing for markets or a bearish thing if there isn't more legislative action on Wall Street. Some people have been wondering whether there would be higher taxation. And I do wonder, Ella, from your perspective, whether this is a risk or possibly a tailwind to markets more broadly, that the Fed might not be incurring more debt and engaging in more spending.
Well, we think that the eventuality that it happens is well flagged and well priced. It's one of the reasons where the market consensus has grown to be more optimistic about growth in the U.S. Next year. So that side of the equation, if you like, is featured. If you want to protect for it not happening, and therefore the Fed having to do less hikes than what the market projects into the curve, then we think you should probably be positioned in the 5 to 10 year part of the curve, because this is where we've been bearing quite a bit of the brunt of that tighter hiking cycle from the Fed. So, we would not focus too much on it more medium term in terms of exactly when this comes. And the reason for that is we think that fiscal policy tends to wear out over time. So in the broader context of where terminal rates should be, we think it plays less of a factor. But shorter term, yes, we can. It can play more along the curve.
Robert, what's your perspective, given the fact that people had expected this government to actually engage in a massive amount of fiscal stimulus? Certainly there was that last year, but it seems like there's diminishing appetite to really deepen the deficit.
Right. Well, I think that, the fiscal impulse is going to be negative no matter how you slice it. The real question is just how big is it going to be? I think that the package that's been out there, that's been worked on and so on, was always going to be over time. So it could be a big number, but it's going to be nothing like what we've seen in recent years, or recent quarters, where the money just hits with very high-powered, like this child tax credit, cash in hand. What we've been looking at coming down the pike, whether it is coming down the pike or not, is much lower octane. I think in terms of deficits, those certainly in the U.S. look like they are here to stay in a very, very big way. And even in Europe, they're moving towards a new framework that's not going to be as restrictive as what they've had in the past. So I think, whether you call it MMT or what, big deficits, they appear to be for a lot of countries, here to stay.
Michael, what's the market implication for you for that?
I think that what people are looking to understand is directionally where the government is going on its policy with regards to deficits. I think what we've seen over the last couple of years is issuing a tremendous amount of dollars to stabilize the economy, and now with a plan like Build Back Better, that's pretty heavy. We want to get a sense as to how much spending are we expecting and what is that deficit going to look like. I think that's a little bit of the push and pull that you're seeing on the Hill, where there's a question as to how much we should be spending as a government and how deep that deficit should go. As soon as we get a little bit more clarity on what the policy is going to be and a little more comfort that we're not going to be just issuing more and more dollars, I think we're going to see more stabilization in the market.
All right. Well, Michael Weiss, Ella Hosha, and Robert Tipp, thank you all so much. Have a wonderful holiday season. We look forward to seeing you next year. For some of the sector price action this morning, let's get over to Bloomberg's Kriti Gupta. Kriti, what are you seeing?
Yeah, good morning, Lisa. Pretty broad sell-off when it comes to the S&P 500 on a sector basis towards the top of the pack. You have those yielding sectors, real estate, utilities, consumer staples towards the bottom. Energy, financials, of course, following those oil prices lower. Information technology is an interesting story, though, because at the start of the session, tech was actually one of your laggards. It has been pairing some of those losses in just the first about 22 minutes of trading. I want to really hit one of the major movers today to the upside, though, because, Lisa, it looks like we all need some good news, so let me give it to you. FedEx beating their estimates. This, of course, boosting their outlook, driven by their Express unit. This is a company that has not only served as a proxy for the overall economic activity, but also that one that's been able to navigate those labor issues, offering higher wages, raising their prices, and focusing on those smaller shippers. Take a look at what it's doing to the Dow Jones Transportation Average, one of the, of course, heavy hitters in the Dow. It's actually boosting the index at the moment. So something to watch for, of course, is as a proxy for that economic activity, is the signaling perhaps a market rebound?
Yeah, Kriti, possibly good news or possibly bad news if you're spending a lot of money getting FedEx packages ahead of the holidays. Coming up, the market-moving events that you need to be watching. That's next in our trading diaries. In the markets, what you can see is that sell-off continuing to deepen across the board, although actually pulling back a little bit if you look at the S&P and NASDAQ. Now the S&P at 46.22, down 35 points. The S&P down, the NASDAQ, excuse me, it's 15,170. It is down about 0.5%. You get a bit into bonds today as people look for some haven. From New York, this is Bloomberg.
is oxygen.
25 minutes into the trading day, and you can see that sell-off sticking. The Russell 2000 deepening some of its losses, down nearly 0.9%. And what you can see in bonds is that ongoing trend downward, specifically in the long end, with that 10-year yield 137.67. This is notable given the hawkish tilt and given the fact that 2-year yields are now higher, that flattening yield curve continuing. Time now for the trading diary, what you need to be watching for the rest of the week and also today. Treasury Secretary Janet Yellen hosting a virtual Financial Stability Oversight Committee meeting at 11 a.m. Eastern. Then Fed Governor Chris Waller and San Francisco Fed President Mary Daly speaking at 1 p.m. Plus, we'll get the Baker Hughes rig count and a host of U.S. data coming next week, starting on the U.S. GDP on Wednesday. Then we'll get personal income and spending data on Thursday, along with another round of initial jobless claims and the University of Michigan Consumer Sentiment Survey. This was Countdown to the Open. This is Bloomberg.
Thanks to the speed and effectiveness of vaccination, we have 90% of the population vaccinated, and so the impact so far is much lower than in other neighboring countries.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
Friday, December the 17th, we're 30 minutes into US trading. What do you need to know? Let me lay out the top stories for you that we're going to be following this hour. Stocks, well, the post-Fed hangover continues into Friday Also expect a bumpy ride as we work our way through over the next few hours, triple witching. Data out of South Africa today showing a much lower rate of hospitalizations. Omicron sweeping rapidly across that country and now much of the rest of the world. Rivian tumbling as well. It's told investors that it's going to miss production targets. We're going to be speaking to GM's chair, Mark Royce. His company delivering its first all-electric Hummer today. We also need to talk about why the stock is a little lower. The CEO of Cruise, the autonomous driving unit, departing, a surprise departure. We'll talk to Mark about the details surrounding that. From London, I'm Guy Johnson, my co-host in New York today, Sonali Basak. Alex Steele off today, doing a bit of pre-Christmas baking. Welcome everybody to Bloomberg Markets. Sonali, we need to talk about our question of the day. We need to talk about what's happening with these markets. What has changed this week? And you made this point in our morning meeting this morning. How fragile are these markets? Let's bring in our good friend and colleague, Romain Bostic, Bloomberg Markets co-host, to give us his take on all of this. Romain, it's been an incredibly bumpy week. We're still trying to figure out what it all means. The dust, I don't think, is completely settled. What changed for you this week?
I think what changed here is the tone of what we got out of the Fed. Remember, this was a real shift in focus, a focus that for most of this year was focused on maximum employment. And what we heard out of Jay Powell earlier this week, as well as on that testimony back on November 29th, was that the focus is now firmly on inflation. And more importantly, Guy, on a lot of the data that we're starting to see, that a lot of purchasing decisions by consumers and by businesses are now starting to be altered by the pace of inflation. That's what the Fed's worried about, and it appears that's now what the market is worried about as well.
Yeah, speaking of the market, you're better at this than anybody. What does a 1% decline in the S&P really mean?
Well, it doesn't mean much when you consider the record high that we're at. But, I mean, look at where we are. You go back a year, almost a year today. You know, we do these surveys here at Bloomberg where we poll all the strategists. We say, where do you think the S&P is going to be at the end of the year? We did this in December of last year. What was the median, the average, I should say, estimate? What do you think it was to end 2021?
43?
4,000.
Okay.
Yeah, we passed that, I think, on April 1st. And even the highest estimate in that survey was 4,400, which we passed back in July. So we're well above everyone's expectations at the end of last year of where we would be at the end of this year. So when you look at a 1% drawdown here, Sonali and Guy, and you put that in a context of where folks expected us to be at the end of the year, we're still sitting in a pretty good place here. And I don't think you see panic on the street, but you certainly see some repositioning.
Sonali, you talk to a lot of bankers. What are they telling you right now? This has been an incredible run this year. The market has got tighter and tighter as well. Big tech absolutely dominating. What are they telling you? What is the kind of the tone that you're getting from people right now on Wall Street?
You know, it's interesting. It's that we're going to head into a fine place, but not a great place, that everyone should expect to be making less money next year than they did this year. But with that said, they're looking for investors who are willing to invest for the long term and ride out the volatility into next year, Guy. I'll steal a line here from Josh Wolf at Lux Capital, where he thinks this to-the-moon rally just cannot continue. Romain, you know, this to-the-moon idea, what happens to these to-the-moon
Well, let's talk about to-the-moon. I don't know if we have the data here. I see this big chart. This is a great studio you guys got over here, by the way. We should get this for our set. But, I mean, you talk about some of the high flyers. You talk about the ARK Innovation ETF. That was, of course, the big winner last year, and it's down pretty significantly this year. But when you look at what we've seen just over the past couple of months, ARK Innovation down something like 20%. The Renaissance IPO ETF, which tracks IPOs, which, again, sort of the bloom has come off the rose of that. That's down something like 17-18%. And then, of course, we all know what's happened to crypto here over the last couple of weeks. So the riskiest assets out there are starting to see a little bit more of a breakdown. And I think you're starting to see panic there because there's no real footing there, right? But then when you look, Guy and Sonali, at a Microsoft or an Apple or even a Tesla here, there are fundamentals that underpin those companies and to a certain extent underpin the rise that we've seen in those stocks.
But those are the stocks that are underpinning these markets.
Yes.
Those are the stocks that are underpinning the S&P. It's big tech. That's where all the weight is right now. If big tech has a problem, this market is looking very, very vulnerable. And this market has got narrower and narrower. We've seen this kind of ongoing rotation.
Yeah.
And as we've seen those rotations throughout the year, money has become more and more concentrated in big tech.
Yeah, and exactly to your point, let's look at software stocks, for example. This is another example. Something that kind of flew under the radar yesterday, about 24 hours ago, was this big earnings warning that we got out of Adobe here. And this is kind of what we're talking about. These stocks made up a big portion of the gains that we saw earlier this year. These are also stocks that have some of the highest multiples in any of the indices. Pick any indice here in the U.S., and the biggest multiples tend to be baked into a lot of these names here. So when you start to hear those companies talk about a slowdown in their growth rate, whether it's on revenue, margins, or on EPS here, that causes a lot of concern. So you saw a huge sell-off in the software stocks this week. In fact, that's going to be one of the biggest underperformers here, not only this week, but probably for the month of December.
Shanali, equity vol tends to follow credit vol. The credit market has had a great run. I know it's going to be a little bit cautious into probably year end, but there's a lot of things lined up for the beginning of the next year, I hear. What do you hear about the credit market going into next year? What do you hear about what the story is? Companies have really taken on a lot of debt. Are they going to continue to do that? How much risk is there?
Incredible. There's two things going on at the same time where leveraged finance markets have jumped back to records, and private equity is sitting on so much dry powder that they're willing to still do deals, propping that market even higher. But then you look at Citigroup's call, Guy, the idea that $70 billion worth of high-grade bonds can face downgrades into next year as the economy slows, as rates rise, then you've got to wonder about investor risk appetite when it comes to taking risk in corporate bond markets, especially when you look over that long term when some of these companies just may not make it through.
Yeah, I think that's going to be, it's going to be interesting to see which is the lead asset class as we work our way through these rate hikes. How are we going to see credit, the bond market? The bond market is signaling basically at the moment that the Fed is going to be making a mistake. The credit market looks a lot more sanguine still at this point. But if you take a look at the yield curve, the message is pretty clear. And I know Jay Powell tried to downplay this in the press conference, but the message at the moment is, are we setting ourselves up for a policy mistake?
Yeah, that's the big question here. I mean, you get a lot of different opinions depending on who you talk to. But when you look at the price action in the bond market, it seems to suggest that not everyone is really on the same page with the Fed right now, whether it's with regards to the end of the taper, the start of those rate hikes, or the number of hikes. I mean, we had Richard Saperstein of Treasury Partners on yesterday on Bloomberg Markets to Close. He's actually in the thinking right now that we may not actually see any hikes next year, despite the fact that you're already, getting this this guidance of about 3 hikes in 2022. Now, he seems to be a little bit more on the extreme in terms of his predictions, but you are hearing other folks saying that 3 hikes probably isn't going to happen. You're probably going to get 1, maybe 2, but considering where the economy is going, 3 may actually be a little bit of a stretch here. And can I just turn the tables on you for 1 second, Guy? Because, another point that was brought up here was the underperformance of a lot of the European assets relative to the U.S., the underperformance of a lot of global assets relative to the U.S. And the big question a lot of people are starting to ask is, when do you see that catch up, if at all?
Well, if you think about it, if you do see the reflation trade coming back, the value trade is going to be really interesting. Europe, in many ways, is geared to that cyclicality. The other factor as well, Romain, in all of this is what's been happening with the dollar. The dollar has been strong. Let me just kind of bring up my WEI screen because I can give you the evidence behind this. If you're a U.S. investor, let me flip this round so I can talk about it from a dollar point of view. If you are a dollar investor investing in Europe this year, let's take the Euro Stoxx 50 as an example. If you're a euro investor in the Euro Stoxx 50 this year, you've made 16%. If you're a dollar investor, you've made 8%. The currency has really hurt this year if you're a US investor. I think that's kept money at home, and it's the exact opposite for European investors investing in the US. So money has just been pouring in your direction.
Yeah, that's a fantastic point. And I mean, we talk about some of the dollar strength that we saw this year. Again, going back to where we were last year when people were making predictions, you really didn't hear anyone talking about an up year for the dollar.
Guys, we have to leave that there. Are the markets more fragile? We'll be asking that question all day. Thanks to Bloomberg's Romain Bostic. This is Bloomberg.
Time now for the Bloomberg Business Flash to look at some of the biggest business news stories in the news right now. I'm Angel Feliciano. U.S. regulators have fined J.P. Morgan $200 million for breaking rules involving employee communications. Bank executives were supposed to make sure that workers' messages were archived for regulatory scrutiny. But even the bosses shrugged off the rules they were supposed to enforce by using platforms such as WhatsApp or personal email addresses for business messages. Amazon's customers in the UK will now be able to pay in monthly installments. That's a result of a new tie-up between the online retailer and Barclays. Purchases of $133 or more on Amazon will be eligible for the new flexible payment method. Buyers will be able to spread out the cost from between 3 months to 4 years. And shares of Rivian Automotive are tumbling after its first earnings report as a public company. The electric pickup maker said it expects to fall short of its annual production target. The EV startup will be a few hundred vehicles short of its goal to produce 1,200 units by the end of the year. And that's your Bloomberg Business Flash. Shanali, Guy?
Angel, great stuff. Thank you very much indeed. Actually, I want to pick up on that Rivian story. The Rivian slump is continuing. I think we're down now, circa 15% on the stock. I think that's the lowest as well, Shanali, since the IPO. It's certainly turning out, there we go, we're 18%, it's a two-day chart, but we're off by 18% over the last couple of days. They're only talking about missing by a few hundred vehicles, but they're not producing that many vehicles, so that sounds like a big chunk of change.
Yeah.
It looks as if they're focusing on the Amazon story.
Yeah, a few hundred vehicles out of 1,200 vehicles, Guy, that's 25% potentially of the vehicles they were supposed to make. Indeed, that's right, they are trading the lowest since the IPO, and you've got to wonder where those patient investors are when it comes to those near-term hiccups that the analysts are saying that are inevitable.
Yeah, and that's the point, isn't it? That this is going to be something that all of these new startup companies are going to have to deal with. And Rivian has got a lot of things on its plate right now. It's trying to make these vehicles for Amazon. Amazon has obviously backed the business, trying to get everything lined up in a world where you're dealing with labor, where you're dealing with chip shortages, when you're dealing with trying to figure out how to make cars, mass-produce cars. Super tricky for the super tricky. We spent a long time following Tesla. Every time it had a production update, it has turned out to be a company that can deliver, but it's a huge challenge. The engineering around this is hugely complicated.
Inputs won't be cheaper, and guess what, Guy? The cost of capital also won't be cheaper to finance these projects moving forward, so bumpier road ahead.
Yeah, can they all survive? Are all of these car companies going to survive? Are all these startups, the IPOs, going to be around? Is the pie going to be big enough? Or actually, in reality, are we throwing a lot of stuff at a wall and then we'll see exactly what sticks? Clearly, the original OEMs, the ICE OEMs, the car makers like GM, Volkswagen, Ford, etc., are going to have something to say about this as well. We're going to catch up a little bit later in this hour with one of them, Mark Royce, General Motors president. He's going to be talking about GMC's new Hummer EV. We'll also get his take on Dan Ammann departing from Cruise, which is their autonomous driving unit. That's what seems to be driving the stock lower today. We'll talk about that with Mark, get his take on what exactly the message should be. Let's get back to the markets. Let's talk about what we've got coming up for you. BlackRock's head of iShares Investment Strategy Americas is going to be joining us, Gargi Chowdhury. Coming up next, how fragile are these markets? That's the question we're trying to figure out today. We'll talk to her next. This is Bloomberg.
in technology.
"48 minutes into U.S. trading. Let's get back to our question of the day. What has changed this week and how fragile is this market? Let's bring into the conversation Gargi Chowdhury, BlackRock head of iShares Investment Strategy Americas. Gargi, let's kick it around. We've clearly got a kind of post-Fed hangover that we're still dealing with this Friday. How fragile do these markets feel to you?
Sure, Guy. Good to be here again. These markets feel very fragile today, but I'm going to say that it doesn't actually have much to do with the Fed or the message from the Fed on Wednesday. It's much more around fears around the virus and how that might look over the next 2 to 3 weeks, especially here in the U.S. So it's, I think the Fed's message was clear. It was one around the economy needing to remove accommodation because of the strength in growth, the labor market, and inflation reaching target. But I think the market is feeling fragile because we're looking at some higher numbers today than we did just 2 weeks ago, and expecting them to go higher higher over the next few weeks as well, with everyone traveling for the holidays.
In some ways, it's easier to adjust to an interest rate strategy, but with the way the variant is moving and creating further work from home strategies, you see energy and financials down more than anything else today. How do you adjust your investment strategy, Gargi?
Sure, Shanali. So I'd say a couple of things. First of all, let's hope that we're all wrong about the efficacy and the transmissibility of the virus, and more so the severity. And even if that does pick up over the next few weeks, especially amid the year-end illiquidity, if it does create some volatility, I think we have to look within our portfolios into 2022 on what might be driving the markets outside of the Omicron variant, and what might some of those be. So number one, we already heard from the Fed, and we saw that they're still going to have a very muted policy path. So yes, the FOMC was considered a little bit more hawkish, but I'm going to say that looking past the 2022 three-dot surprise, we're supposed to look at the 2024 rate hike path, or the 2023 rate hike path, which again looks quite muted. And throughout this entire period, real rates remain negative. And I think that is what is going to drive equity market performance for 2022, which we still think will be positive, not as positive as this year, but we still think you're supposed to focus on that negative real rate dynamic. We're supposed to focus on the tremendous growth that we're seeing in the U.S. economy, that we're seeing in the labor market, and that is what is going to be the driver of markets after we look past this Omicron-related volatility over the next couple of weeks.
I hear what you're saying, but I look at a stock like Apple. I came in on Monday and everybody was super excited about Apple getting to $3 trillion. This week, Apple's down by 5% and has fallen quite sharply post the Fed. Gargi, this market has become very concentrated in some very big tech names. And I'm wondering, in the kind of environment going forward, whether this narrowness is going to be a risk.
I mean, look, it's certainly something that we're all paying attention to. I mean, obviously, we all know there are 5 big names that have resulted in more than 35% of the year-to-date returns. I think that, you make a good point about the technology sector. Obviously, there's been a little bit of a pullback. But if we think about right after the FOMC, press conference happened on Wednesday, actually the tech sector traded just fine. It was much more, yesterday and today where there's been a little bit of a pressure. So yes, the breadth or the lack of breadth is something that we're going to focus on, and that